Hey, Steve Skretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value, entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. I wanted to touch this week on sort of, what's happening in the global economy, particularly with some of this coronavirus, and then how that's really not filtering into a lot of financial markets. There is still that sort of risk-on behavior that I've talked about, where people are sort of ignoring any sort of data that might suggest, a slowdown, or it's kind of a don't fight the Fed mentality. And so, if we talk about like the coronavirus, specifically, the World Health Organization just came out this last few days basically saying it is now officially a global emergency to sort of deal with this virus. We've seen China travel is basically shut down at a crucial time of the year. Chinese New Year is the single largest migration, roughly about 600 million people moving in and out of China during that period of time. So, even you can see here domestically, a company like Air Canada banning flights to Beijing and Shanghai. So you can imagine what that might do for, say, some of these global property markets, Vancouver, Toronto, that are, maybe looking forward to, as if you're a property developer, maybe looking forward to that week and saying, okay, I got some luxury condos here that I maybe would like to sell. Certainly a lot of the advertising and marketing is geared towards Lunar New Year, and obviously seeing the timing with not only the coronavirus, but obviously the ramifications of that, which is essentially shutting down a lot of the travel. So I think that is, definitely not going to help sort of those pre-sale luxury condo sales, maybe on the high-end side as well. But what I can tell you is that domestically is that hasn't mattered. I can tell you that there is starting to build this sort of fear of missing out once again. We're seeing a lot of multiple offers in the Vancouver housing market, particularly as it pertains to condos, anything that resembles like some sort of affordability. I think that these are rampant. I think that the inventory, continues to be sort of plagued. And basically what you're seeing is, for whatever reason, there's no new listings. And if you look at nationally, it's the fewest new listings nationally across Canada since 2007. So again, you have to ask yourself, okay, well, why are people not listing? I think that has to do a lot with the low interest rates and there not being a trigger forcing people to sell, i.e. raising rates and creating financial stress. So they're still pumping a whole bunch of liquidity essentially into the system, which basically helps mask over malinvestment, which I don't think anyone would disagree that there's obviously a lot of malinvestment. Canadian households are the most indebted in the G20, so I don't think that that's any sort of secret there. But I actually, truthfully, if you're asking me, in the next 3 to 4 months, my sort of outlook on the local housing market here specifically, despite what the data is doing, because apparently people are just essentially ignoring that, I actually think, and I'm seeing it, prices are beginning to rise again. Specifically in the condo market, you're seeing a lot of action as well, though. In the detached housing market, lots of bidding wars, people just stuffing themselves through open houses. And honestly, it feels almost reminiscent of sort of 2017, where you had sort of that reflation again after, towards the end of 2016, we had a very weak end of 2016 after the introduction of that foreign buyers tax, which kind of shocked the market. But it seems like people have sort of digested that now. And because of this drying up of new listings, the inventory has essentially fallen off and it's created this hysteria again. But not only that, if you bring it all back, you have this coronavirus, which the markets are interpreting as, okay, lower, weaker growth, so let's push the bond yields down. You've now, after the Federal Reserve cut rates 3 times to essentially uninvert the yield curve. The yield curve is now reinverted essentially back again. So what does that do for the Federal Reserve? It could very well lead to more interest rate cuts. I don't know how they're going to proceed with that, but what I can tell you is that in the bond market specifically, you are starting to see obviously yields come down, and you're seeing that reflect in 5-year mortgage rates here in Canada. So you have 5-year fixed mortgages are now back down to 2.79%. In some cases, you might be able to get it a little bit lower than that. But you're now entering a situation. Just framework this for me, and again, try to put any sort of bias out of it, because again, I'm certainly one that would focus on the data and say, okay, well, the macro certainly doesn't look very good. There's certainly a lot going on, and there's a reason why yields are falling. It's because the bond market's interpreting weaker growth. And in fact, if you looked at U.S. GDP for Q4, you would have seen a 2 handle on it. But if you actually looked at how weak the imports were, had they not been so weak, you would have had a 0 handle on the GDP for the United States. So there's clearly a weakness in the sort of global economies. But you now have a situation where because of the drying up of new listings, because of central bank liquidity pumping into the market, and because of those yields coming down and having 5-year fixed mortgages at 2.79%, you're now about to enter into a spring market in the next month. Next month to 3 months, you're about to enter into that spring market, which is historically the busier time of the year. We're already seeing multiple offers right now in January. So you're going to enter into that spring market with 5-year fixed mortgages falling back down now, again, to 2.79. Those could easily drop back down to, say, 2.5% at the current pace that yields are falling. So you enter into the spring market with rates at 2.5%, and the fewest new listings nationally since 2007. So we have the fewest new listings nationally in Canada since 2007, at a time when interest rates are falling back down to 2.5%, and central banks are still pumping a ton of liquidity into the system. So I think that is creating a recipe for disaster. And if you ask me unbiasedly, that you are seeing condo prices beginning to rise again, at least in parts of the city of Vancouver. You're seeing continued sort of rebound in the detached housing market. We are seeing multiple offers there in some price segments. Again, the high end of the market still remains incredibly weak, and obviously we know that has a lot to do with the foreign investment, particularly out of China, which is not getting any help from the coronavirus. So I think it's creating a very interesting outlook for the spring of 2020. Personally, I'm bullish on the fact that I think prices are going to move higher. I'm not saying that is going to be a sustained move. I think that clearly we know that the fundamentals are broken. They've been broken for some time. But all you have to do is look at what's happening right now with sales and the fact that the inventory is incredibly low after having built up over the last year to year and a half, has fallen off dramatically once again. And primarily a lot of that has to do with new listings falling off. So unless you get a sudden reflation of people listing their home for sale, I don't know what that catalyst is. There needs to be a sort of a catalyst to essentially force people to sell. We know that certainly for people that go delinquent, that it takes time. It takes time to build inventory levels. That's just like the reality of that, how that works. Housing isn't like the stock market where 1 week it goes on, 1 week it goes off. It's very slow moving, so it takes time for inventory levels to build. It takes a little bit of time for sentiment to change, and obviously that's how things are shaping up into that. It seems to me that Canadians have essentially almost digested the B20 mortgage stress test. We had OSFI out this past week saying that they're looking at potentially revising the mortgage stress test. It looks like they're going to change potentially the benchmark qualifying rate set by the Bank of Canada. I think right now it's at 5.34%. So they would potentially just try to lower that rate or make it more flexible to sort of track and follow bond yields essentially. So you'd still probably have a stress test that is your borrowing rate plus 2%, right? So if you're borrowing today at 2.79%, that would be 4.79% you'd have to qualify at, which is obviously a significant, decent amount lower than the 5.34 that it would be stuck at today. So I think that could potentially matter. But it seems like if you even look at OSFI's stress test, you can see high ratio borrowing, of an income to mortgage of 450%. you're seeing those levels start to grow again. So prior to the stress test, we saw those numbers sort of peak and start to fall off, and now you can see that we're getting highly indebted borrowers back into the market, and it certainly seems that people are doing whatever it takes. I think that there's certainly a lot of bank liquidity still excited to lend into the housing market, and so that's kind of what it is. It's kind of ignoring the fact that you have this global outbreak in a coronavirus. It's ignoring the fact that GDP growth continues to slow, hiring, wages, those all continue to slow. But the fact of the matter is that there's this, sometimes financial markets deviate from the underlying fundamentals, and I think that is certainly the case that we're beginning to see, or we are certainly seeing, in the Canadian housing, and as particularly I focus in the Vancouver housing market. So hope that helped. Going to change up the line. Hope that helped. If it did, hit thumbs up, subscribe, and we'll see you next week.